From Bloomberg's World Headquarters in New York and from right here in London, I'm Caroline Hyde.
I'm Joe Weisenthal. Romaine Bostick is out this week.
And so this is what we have a look in terms of the markets. He missed the S&P 500 rallying, but it seems to all be big tech at play. Is it a search for safety as the yields, they come lower, Joe?
Question is, what'd you miss? Now, for more, I want to welcome
let's go
Bloomberg's...
into some breaking news because we've got to, what we're missing right now is a recovery that is far from complete, according to Jay Powell. We're getting some breaking news coming from the Fed chair as he's set to speak later in the week. Recovery is far from complete. The Fed support is going to continue, I understand, Joe. It's remarks in a text of some testimony he's going to be giving for the House committee. Remember him and, of course, Janet Yellen, who was the predecessor at the Fed, are going to be giving evidence. Indications of activity and employment that have turned up, a labour market with conditions that have recently improved, Joe, and recovery that is faster than expected and looks to be strengthening. But millions of Americans, there's the line, Joe, millions of Americans are still hurting. It speaks to the fact that they are all about the labour market.
Absolutely. All right, for more, let's welcome Bloomberg's economics editor, Michael McKee. Michael, it seems to me that the continued theme here from Powell, message discipline. This vision of not doing anything until we get back to something that he accepts.
Yeah, and less in this than even in his testimonies in previous weeks. The Fed just releasing his testimony before the House Financial Services Committee that he's going to give tomorrow, getting an early start on not moving the markets. He will appear with, of course, Janet Yellen. Nothing much he hasn't said before. The virus is still in control, he'll say, but there is a bit of an optimistic cast, as you heard it, as Carolyn read the headlines there. The recovery has progressed more quickly than generally expected, Powell's going to say, and looks to be strengthening. This is due in significant part to the unprecedented fiscal and monetary policy actions I mentioned, which he mentions earlier in his testimony, which provided essential support to households, businesses, and communities. Now, that's accompanied by a warning and a promise, much more to be done. We welcome this progress, Powell says, but will not lose sight of the millions of Americans who are still hurting, including lower-wage workers in the services sector, African Americans, Hispanics, and other minority groups that have been especially hard hit. And he goes on to talk about how the Fed's rate cuts and lending programs helped as much as the fiscal side, keeping the economy going during the past year. They're committed to using their full range of tools to support the economy and help assure the recovery will be as robust as possible. Stop me if you've heard that before. So as Joe and I were talking about, there's not a lot here to trade on. It is message discipline, staying in his lane. Still, what's interesting is despite all the talk about this being a fiscal policy moment, the Fed is still dominating trading. The markets decided today, apparently, the bond market, that we were going to, that they had perhaps overreacted to what the Fed was doing. Bond yields fell kind of across the board as people got back into bonds. Most of the action at the longer end. We don't have any signs of inflation yet, the Richmond Fed Bank President Tom Barkin said, and that helped the NASDAQ gain 1.25 percentage points. The S&P 500 up 0.7, the Dow 0.3. And speaking of Jay Powell, he told a conference today the Fed's looking at digital currencies, and I know Joe was all over that.
Oh, yeah.
He's in no hurry to create one. So...
No Fed coin imminently, but I'm interested, Mike, in your perspective. You talk about yields coming down. I wonder whether that was a search for safety as well in some way today. We have not particularly COVID great numbers coming out of the US. We're worried about Germany's shutdown, but it's also, we have a big week for technicals at play when you have such big auctions, 2-year, 5-year, 7-year. Is that something that the Federal Reserve is going to be keeping a close eye on, do you think?
Only to the extent that we would have a bad auction. And we do get a 7-year on Thursday, and that was the one that got everyone's attention last month with basically the worst 7-year auction in history. So that will get some attention. But as long as the market is functioning, the Fed's going to be okay with it. What we really want to find out is the rest of the world okay with the U.S. issuing all this debt? And it does seem that technicals and the Japanese repatriating profits rather than buying treasuries was the big issue with the sevens last time. We'll see if that's what happens this time as well.
We want to thank you, Mike McKee, all over what's happening, technically speaking and fundamentally. We thank you as we await that testimony, of course, starting tomorrow. Coming up, we continue our conversation around the Federal Reserve. Neil Dutter's going to be with us of Renaissance Macro Research, joining us with his pushback on a few Fed myths, as he calls them. That's next. This is Bloomberg. So just a few moments ago, we received Fed Chair Jay Powell's prepared testimony to be delivered tomorrow to the House Financial Services Committee. Now, Powell stating that, again, the economy seems to be gathering some steam, though it is still far from fully recovering, particularly in the labour market, Joe. There's been this push and pull so far in terms of trying to understand what the Fed's real narrative is. But from your perspective, I mean, it seems pretty evident he's sticking to his hymn sheets, isn't he?
Exactly right. Because, of course, we have seen this pretty substantial backup in rates, as they call it, 10-year yield coming down a little bit today. But you see there, I mean, pretty dramatic, especially since early January. And yet, given multiple opportunities, we have yet to hear Chairman Powell say anything about wanting to push this down or discourage the sell-off in treasuries at all, perhaps surprising some people, which is perhaps accelerating the move or not. But the question is the market testing the Fed in some way? So joining us now to discuss, Neil Dutta, Renaissance Macro Research Head of U.S. Economics. Neil, thank you so much for joining us. You put out a note this morning talking about myths regarding the Federal Reserve. So let's start right off the bat. One popular myth. Is the market testing the Fed in some way here?
I don't think so. I mean, I think, you mentioned the 10-year yield, the Treasury market. That's largely a function of growth expectations. I mean, why would the Fed push back against 10-year yields? It would be akin to pushing back against rising growth optimism. So that seems sort of foolish. I mean, what would people prefer? I mean, have the Fed talk down the economy, then start ginning up talk in the markets about the Fed knowing something about the outlook that no one else does, pushing yields lower? I mean, mission accomplished, I guess. I mean, it's sort of, I don't really quite understand it. I think the bigger story is that, yes, interest rates are up, but if you look at broader financial conditions, Joe, and I think this is a point that Powell made, beautifully last week, is that broad financial conditions remain accommodative. Look at high-yield corporate credit. They're basically at the tights. There hasn't been much of an upturn in the dollar. Obviously, equity markets are quite buoyant. I think when you look at the aggregate sort of, stance of the financial markets, it's highly conducive to economic momentum.
Yeah, you can track that on the Bloomberg with the Financial Conditions Index. Clearly still very good, relatively speaking, Neil. And I'm interested in, therefore, we keep having this narrative. We love it, of course, across news to be like the bond market's pushing the Fed or there's some sort of tussle. But does the Fed even look to the market to vindicate its own performance in any way or to see that its credibility is still riding high?
Well, I mean, to me, I would say that this is not unusual, right? I mean, this idea that the markets are kind of pricing in a tightening cycle that doesn't actually come to pass. I mean, that was a hallmark of the last cycle, right? I mean, the markets kept pricing in a more aggressive Fed. It never arrived. It took years for the markets and the Fed ultimately to align. So I think the way people should think about this disconnect between, let's say the Fed's guidance and the forward, sort of Eurodollar markets, the Fed futures market. It's just an opportunity for the Fed to ease later, and I think for investors it just creates, sort of nice little trading opportunities in the, let's say, in the belly of the yield curve on in. Because I don't think the Fed is going to hike anytime soon. I think they've been very clear about that. And the proof of the pudding is in the eating, right? And so as the data comes in and it's being shown that the Fed is not actually getting off its seat and moving closer to the exit door, I think bond market investors will sort of come around to the idea. And this is a point that I've been making, is that the Fed's view of what constitutes maximum employment is a very expansive definition, and it's something that a lot of people have no real experience with. I mean, this isn't just about the unemployment rate. This is about bringing those that have historically been at the margin to the labor market back into it. And that, to me, is a much higher bar than people appreciate.
What about this idea, people have likened this to a taper, the tantrum. In 2013, the taper tantrum. It has been dramatic, the backup, but you don't think it's anything comparable to that?
Well, I mean, if you look at take a look at the 10-year total return index, right? I mean, the drop in that so far, it has been about the same as what we saw in the taper tantrum. The only difference, of course, is the taper tantrum happened in about four months. I mean, this is a little bit more drawn out. So, I don't see it. And, of course, that back then, I mean, if you go to 2013, that wasn't just about the 10-year yield going up, Joe. It was also about the 2-year yield going up. But if you look at what the 2-year yield has been doing since 10s have been backing up, it's basically stuck at 15 basis points, which tells you what? That the Treasury market isn't really sniffing out a Fed hike. By contrast, in 2013, no, that was actually going on. I mean, people thought the balance sheet adjustment was a sign that rate hikes were around the corner. Eventually, as is usually the case, the markets and the Fed kind of figure each other out. But so this is different. And people are talking also a lot about EM, right? I mean, we've seen that happen a lot, right? I mean, so loose financial conditions or sort of easier policy in the U.S. is driving lots of problems into EM. I mean, it's sort of ridiculous, right? Would people prefer the U.S. run a massive fiscal consolidation, the Fed start hiking rates to help loosen financial conditions in the emerging markets? It seems kind of nuts. So I would just say that even when you look at EM, I mean, EMFX is not weakening the way it did in 2013. In 2013, you saw a pretty substantial sell-off in emerging market currencies that you haven't really seen so far this time around.
Yeah, we're going to be debating much more emerging markets and the idiosyncratic news coming out of Turkey, for example. But as we therefore do see this sort of push and pull between the market and we look ahead to what's going to be not just evidence being given by Jay Powell, but also, and the tea leaves that are going to be read there, but also the auctions, Neil, how much do you expect some sort of pushback up in yields or worry that we had around the 7-year auction that we had last week?
I don't really focus too much on that. I mean, I think there's still an insatiable appetite for U.S. fixed income. I mean, we still live in a environment of sort of diminished safe haven supply. There's still, I mean, Europe is still quite sluggish. So, it doesn't seem to me that these auctions are going to be the big drivers of the rates market. I mean, I know people like to focus on that, but I really just think it comes down to growth and inflation expectations. And, my sense is that economic activity is picking up. And whatever weakness we see in rates, in yields coming down, will largely be temporary in nature.
Neil, real quickly, just going back to this question of the financial conditions overall, is there any threat to real economic activity from rising rates directly? I mean, theoretically, it should hurt housing or maybe autos. Is there any issue there?
I mean, I don't think so, not yet so far. I mean, you could come up with a scenario where that could be the case, but this idea that the backup in interest rates is hurting housing activity, where's the evidence for that? I mean, look at home building stocks, Joe. I mean, look at auto producing stocks. I mean, we're not in a situation where rates are actually hurting people's access to get credit. If anything, you can make the argument that because risk-free interest rates are going up, mortgage spreads have eased somewhat, right? So maybe lending, loan conditions, lending standards have eased a little bit. So, yeah, maybe 30-year, mortgage rates have gone up, but I think more people have access to credit, and I think that's why the housing market's still doing reasonably well despite the backup in rates. But, again, it's very difficult to talk about a tightening in financial conditions just because of rates if the areas most impacted by that are still doing quite well.
We'll see the ramifications. Neil Dada, always great to get you with us. Renaissance Macro Research, head of U.S. economics, with all thing myth-busting on the Fed. Now coming up, the lira. We said we're going to talk Turkey. The lira weakening after President Erdogan fires and replaces the central bank chief. Now, that's the third one in 2 years. We break down the impact with Jason Tuvey of Capital Economics. That's next. This is Bloomberg. So Turkey's stocks, Turkey's bonds, and of course the lira, totally tumbling today as the dismissal of the central bank chief triggered yet more concern that the country is headed for a fresh bout of currency turbulence. Joe, we've been here before. In fact, we've been here 2 other times previously. It's the third central bank chief gone in the last 2 years, and the volatility just sweeps back.
Yeah, it seems like if you're going to cycle through central bank chiefs over and over again, you're going to have currency volatility. And, of course, we saw that in a very big way today. This is the dollar against the lira surging 7.7%. So although it's green, that's because the dollar is rising against the lira. Absolutely getting clobbered after the dismissal of the central bank chief who had previously tightened policy, which, as we know, President Erdogan has not been into. So joining us with more insight, capital economics senior emerging markets economist Jason Tuvey. Jason, thank you so much for joining us. It really feels like sort of deja vu. Every once in a while, you hear about a Turkish central bank official getting fired, the lira plunging as it did today. What does this do long-term for the Turkish economy, for Turkish financial markets, to continue to have this sort of ongoing source of uncertainty out there?
Yeah, I mean, the moves today were pretty incredible, to be honest. And I mean, under the previous governor, Nasi Akbar, there were signs that maybe Turkey was turning a corner. Maybe it looked like this policy shift that we'd seen since November was the real deal. But clearly, President Erdogan couldn't give up his unorthodox theories for too long. And abruptly fired Mr. Akbar. So yeah, we're now on to another central bank governor. It seems someone who is more aligned with what President Erdogan wants. I mean, the result is likely to be some effort at some point in the near future to bring rates down again. But that's only going to make Turkey's inflation problem much worse.
Yeah.
And that probably means continued weakness in the lira going forward.
I mean, you saw serious knock-on effects, sort of globally speaking. We saw Spanish banks take a massive hit, those most exposed to Turkish loans in Europe in particular. Still, that fine line can be drawn between the two. Talk to us about the Turkish banking sector and how much that is a key concern for you.
Yeah, I think the Turkish banking sector is the key area of vulnerability in Turkey's economy. Now, there are some concerns about the effects of the lira in terms of currency mismatches on banks' balance sheets. They're not; those concerns aren't actually as big as they were, say, back in last summer. But the concern that's been there throughout the past few years has been the fact that banks have very large external debts, and these have to be repaid or rolled over quite regularly. So these amount to about 12.5% of GDP. To put that into context, banks. Their liquid assets at the central bank, which they use to repay these debts during periods of stress. These assets are very, very low. And what's more, the central bank has heavily depleted its foreign exchange reserve, so it can't step in either if banks do run into trouble. So I think we will see the lira fall today. CDS premium jumped, dollar bond spreads widened sharply. I think it's the banking sector where we really need to keep a close eye on over the coming days and weeks.
So what, in terms of the future of the central bank going forward, and what are we likely to see in terms of policy, both on rates policy, but also, as you mentioned, the sort of like domestic policy to ensure, holding of lira?
Yeah, it's a good question. I think in terms of rates, it seems Erdogan's desire clearly is to bring rates down. He has been an advocate, opponent of high interest rates. So that's the desire. Getting there, given the very poor balance of payments position, I think is going to be very difficult. In terms of trying to get people to hold lira, I think inevitably there will have to be some sort of capital controls put in place. Maybe not in the very immediate future, but I think that's the road that Turkey is heading down in the long run.
Can you talk to us a little bit more about the global ramifications of this? I mean, I talked about how European banks got dragged lower, but as we do go into day two to digest this, who else gets hurt?
Yes, good question. Actually, I think the risks are really contained to Turkey. This is such a idiosyncratic thing going on that I think we've seen periods before, say, following the currency crisis in 2018, where there were some hit to, say, other EM currencies due to a period of risk-off sentiment. But I think we've seen today, actually, the moves in EM currencies, there's barely been any. I mean, the rand and the lira were down 1%. The rand and the Mexican peso were down about 1% against the dollar earlier in the day, but they quickly snapped back. I think investors are taking this is purely a Turkey story.
What do you watch for, though, in terms of identifying vulnerabilities? So right now, it's purely a Turkey story. But from a fundamentals standpoint, And again, we do seem to be in this pretty broad upswing in markets, and despite the rates, EM seems to be doing fine. But what are the radar signs you look for of when EMs perhaps get into trouble?
Yeah, I mean, like I say, Turkey's very particular here. I think the external position in particular, if you look at the current account deficit, is really large, got large external debts, low FX reserves. Turkey on those measures are sort of out on a league of its own. But we would be looking at similar things for other countries to try and assess vulnerabilities. I think, like you mentioned, any specific links to Turkey we would be looking for, such as, like you say, the Spanish banking sector. But beyond that, I think most of the vulnerabilities in EMs at the moment are quite domestic driven. So in Brazil, with Bolsonaro and the virus developments and what's happening with the public finances there. Similarly, in South Africa with public finances there. I think it's very difficult at the moment to draw specific EM themes beyond what we're seeing in, say, the US Treasury market and any ramifications there.
We want to thank you, Jason Tuvey, of course, a Capital Economics Senior Emerging Markets Economist. We're going to look at how the ripple effects continue on this latest move from the Turkish Central Bank. Meanwhile, some breaking news, music to many's ears, I'm sure, based in America at the moment, Joe. A travel group, so we're talking Airlines for America and others, asking the Biden administration for a plan to lift international travel limits. In particular, they want a plan to be developed by May the 1st. Now, music to my ears, as I say here in the UK, hoping to get back to the US, but it's...
We miss you. Does this mean we'll finally be reunited one day?
Well, you're going to have a word with some US bureaucrats as well on the back of that, waiting for some visa let-ups. But I'm interested, Joe, in this is an interesting take, considering we've just started to see worries coming from the CDC again, numbers starting to tick up in the United States. How does it feel from a gut perspective?
We're in a weird moment because it feels like some people are ready to say, like, the light at the end of the tunnel is here. Start talking about the pandemic in the past tense. And the numbers are still generally going good, but they're still very high. And so we do seem to be in this weird moment where people feel like it's over, but not quite. And I think headlines like this kind of speak to that confusion.
Exactly. And at least there was the optimism that AstraZeneca's vaccine might be another one added to the US market, whereas over here in the UK, well, the tussle between actually getting the vaccine to the United Kingdom from the EU and vice versa, just really hammering things at the moment.
New York was hopping this weekend, by the way. It was great.
Just to rub that salt in the wound a little bit more.
Sorry.
Meanwhile, I was allowed to sit on a park bench with someone else. That does it for What You Missed.
Bloomberg Technology is up next. Have a great evening. This is Bloomberg.